Hi, I'm Ken Frier, Chief Investment Officer of Atlas Capital Advisors. It's early November 2025. The topic of this video is the future return of the S&P 500 US stock index. If we can predict the index earnings 10 years from now and the future price to earnings ratio, then we'll also have an accurate prediction of the future price and the annual return. As you'll see in this video, using reasonable assumptions, we think, for the components of the S&P 500 return leads to a return estimate for the next 10 years of just 3.4% per year. And that's well below what most investors expect from the US stock market. Over the prior 10 years ended September 2025, the S&P 500 total return was 15.3% per year, and that's a relatively strong decade historically. By comparison, the 70-year average is 10.6% per year. But as the chart shows, the 10-year outcome has rarely been in the middle. It's usually been well above 10% or well below 10%. The chart here shows the building blocks of the S&P 500 return over the past 70 years and the past 10 years. Two factors explain why the recent decade was exceptional. First, the price to earnings ratio expanded by 4.3% per year versus the 70-year average expansion of 1% per year. The second factor is that real earnings growth averaged 5.1% per year, and that compares to the long-term average of 3%. To forecast the future growth rate of S&P 500 real earnings, we start with real US GDP growth. If S&P 500 earnings maintain their share of the US economy, the growth rate of earnings in the economy will be the same. Both growth rates have averaged about 3% per year in the past 70 years. And if we combine that real growth rate with inflation, the nominal growth in earnings and in US GDP has been a bit more than 6% per year over this period of time. Looking at real GDP growth, it comes from two sources: the growth in the number of people working and the productivity of those workers. The 10-year annual growth in the labor force is the bottom line in this chart, and the gap between the lines is productivity growth, which has tended to be between 1 and 2% per year. The Philadelphia Fed projects a 2.1% annual real GDP growth over the next decade, and that's lower than the historical growth rate, mainly because labor force expansion is expected to be low, limited by demographics and immigration controls. Next, we turn to the price-earnings ratio. The PE ratio is currently above 25, and that's well above the long-term median of 16.5. While short-term movements of PE are unpredictable, over the long term PE ratios tend to revert back toward the median. A move of the PE ratio all the way back to the median of 16.5 in 10 years would subtract 4% per year from the index return, and even a move halfway to a 19.8 PE would reduce the 10-year returns by 2.2% per year. So with that as a preamble, here are the components of our 10-year forecast. We have 2.1% for real earnings growth, and that's the same as the estimate of real GDP growth. For dividends, we use 1.2% per year, the current dividend yield. The market expectation for inflation over the next 10 years is 2.3%, and we use that. Finally, for the price earnings ratio impact, we use negative 2.2% per year. And that's the outcome if the PE ratio moves halfway between where it is now and the median over the next 10 years. Add all that up, and the total return estimate is just 3.4%. If that holds true, owning the S&P 500 might not make sense. 10-year US Treasury notes offer about 4% with far less risk than the US stock market. Now, we should acknowledge that in most of 2025 and also way back in 2021, we could have generated a low return forecast for the S&P 500 using this methodology. And yet so far, the bull market has endured, mainly because of this surprising surge in price earnings ratios and also the robust earnings growth. These trends are not sustainable, and when they turn, then S&P 500 returns will become disappointing. Thanks for watching, and I hope you found this helpful.